So there are three things or three areas that I have seen are very key to planning for sandwich generation. The first thing is to protect our income. Okay, protect. So I will just give the highlights first and then we'll deep dive into it. The second thing is actually to look into generating. Okay, some of these are really not rocket science, but I will just break it down. Oh, someone is drawing. Okay, never mind, I'll just go on. Yeah, generating income, or rather generating more income, because most of us already have a primary income. And then the last thing is really to segmentize. Segmentize your money to keep, to hive off a portion that are to meet your future needs, not your future wants, and your future needs. And I'll come to that. Okay, if I could just kickstart this by asking all of us, what is your largest asset? What is the largest asset that you have today? Can you just type in the group chat what you think is the largest asset that you have today? Yeah, I see HDB flat, HDB, okay. House, yes. Property, yeah. Okay, we say that it's the largest asset because it has the greatest financial value. Is that right? Yeah. But let me tell you this. The greatest asset you have is actually your ability to earn. Because without your ability to earn, that is your income, actually all these things will be hard to afford. Right? Because most of us are using our active income to direct it into something that we can claim ownership, that we can, own a HDB, we can own a house, we can buy multiple properties. It is our ability to earn an income. That is your greatest asset. And that is why the first thing that we need to protect in a sandwich generation, because we have many financial dependents. If your parents above you who are financially dependent on you, there are two of them. If you have one kid, it's one more. If you have two kids, it's two more. That's four. If your spouse is not working, that's five persons. And therefore, it can seem quite daunting. If your income stops, then everything comes to a standstill. Therefore, the greatest asset you need to protect and have actually is your ability to earn an income. So I want to introduce to all of us the concept of loss of income. Okay, I'm going to stop this whiteboard because it's not working very well. Now, loss of income, basically, we understand health insurance, we understand life insurance, we understand personal accident insurance, we understand car insurance, right? We buy insurances for our assets. But have you thought about protecting your professional income? Because there is a type of insurance where if you're unable to perform your own occupation, that's the very precise definition. If you're unable to perform your own occupation, that is where there is a payout. And the payout will then fund, your everything, just as is if you were earning an active income. And so protecting your income, often a big gap there is people do not realize that they have an ability to protect their loss of income. I see Sukit has just come online. Sukit will understand this quite well because in the airline industry, they do have a loss of professional income for pilots. Okay, if the pilots were, for whatever reason, unable to continue working and medical reasons, and therefore there's a loss of professional income, the airline actually would have secured this insurance for them to be able to cover. Okay, so the rest of us, we all have a chance to be able to do that. In fact, you're able to cover up to 75% of your current income level. You can secure up to 75%. So if most of us, our expenditure is within 75% of our total income, actually the loss of professional income will well protect your ability to earn. Because should you have to cease earning for a period of time, that's where this tool comes into play. Okay, so that's one thing I want to highlight because not many people are aware. On the related note, some people will ask, and especially the clients that have come from overseas in the Western world, a lot of them will ask me, do you all have retrenchment insurance? And because when they lose a job in the Western Hemisphere, in Europe particularly, they do have some form of insurance that can pay out if they lose a job. In Singapore, we do not have that. In fact, in Asia at large, we do not have that. What we at best have is there are certain long-term savings or annuities plan where they do have a retrenchment benefit such that you could stop paying, for a period of time, and the plan will not lapse. Your savings plan will continue, your investment will continue, your annuities plan will continue. But that's as close as we can get. We do not have a retrenchment insurance in Singapore available. The only thing we have is loss of professional income. When you're unable to perform your own occupation, that is the definition. Okay, so that's one thing. Now, the other thing, of course, is oftentimes when we are unable to perform our own occupation, it is often due to an illness. It's not a matter of choice. It's a matter of something happening and we are unable to perform our own occupation. We can't continue work. So that's the part where your health insurance will come in, your what do you call that? Your life insurance could come in. And so this is where I've got two stories to share with you. I've saved the images. I will save the images and I will just speak. Okay, so just stop me if if some thoughts come to mind, or just type in the group chat, because I like it to be interactive, much as I'm not seeing your faces. So this first one is happened something is very, very recent, actually, in the last 3-4 months. Okay, so these two case studies, I have real life stories. Both are very similar. Husband and wife married, both are dual income, both with a child, a son. And in both cases, both kids are less than 7-year-old. Okay. In the first situation that happened just 3-4 months ago, husband basically collapsed at work. He has no chronic illness, no known conditions that he's fighting, but he just collapsed at work. And as a result, actually, very unfortunately, he could not be revived and he passed on. When he passed on, the family then, of course, child is young, right? Wife is earning an income, but not a big income. So, of course, the question is, the child have for the next 15, 16 years before he turns even 21, where is the money going to come from? Okay, because they do have a property loan that is still in place, and then now there is a loss of income because the husband's income, he's the primary income earner. The wife is really just supplementing, paying for her own expenses. So the family income and his parents are dependent on him. Now, while this is happening, actually his parents are in the midst of getting a HDB flat of their own. And he being the primary income earner, they used to be owning a property together, and they decided to split ways, right? So he got his own place, the parents and his parents were getting their HDB, but because the monies were in his hands, okay, so the parents were waiting for him to actually in the before he passed on, just 2 months before he passed on, actually that's the time that they would have to pay for the HDB. But with his passing on, all the monies got stuck. And when they checked his insurance, the only thing he had, which he got some years ago, long time ago, was a 1 million policy. And we'll think like, wow, 1 million. But 1 million was not enough to cover for the parents' HDB, was not enough to cover for their own mortgage loan. So they are stranded. So this is the part where loss of income, we are talking about someone, unfortunately, entirely exiting on life, and there is not enough life insurance on him to cover for the needs. We are not even talking about wants, the needs of the family that he has left behind. The second case is, again, like I said, couple, husband and wife with a child. The child was diagnosed with a rare form of cancer before the child turned 2. And at that time, shortly after, I met the wife, and that was when she told me the story. When the child was born, through a friend who was an advisor to them at that point, they got a 250K critical illness plan for the child on top of a health insurance, medical hospitalization plan that can go up to private hospital standard ward. Okay, because they wanted to best for their first child, right? So that was what they got. But when the child was diagnosed with a rare cancer, one thing they realized was the expertise is actually not in Singapore. The expertise is in US. So they were contemplating whether to go to the US for treatment. And that was when they realized with a $250,000 payout from the child's critical illness plan, it was nowhere near enough for them to be able to do that. So what they had to do was then to settle treatment in Singapore, but the hospital would liaise with the doctors in the US. And so the child was in remission for a while, for about 2 years, before there was a relapse and the child passed on. But in between that 2 years, what happened was because that $250,000 was not really needed, the total bill, hospitalization bill before the child passed on in the final year, actually chopped up to over $1 million. But because they had a very strong hospitalization plan, it covered for their bills. From the time they had the payout of the critical illness $250,000 to the time where, the child was in remission for about 2 years before it relapsed again. In between that time, the wife actually contracted cancer too. Okay, so yeah, so it's a very unfortunate case, right? While the child was in remission, the mother then was diagnosed with cancer, but it was quite an early stage thing. So it didn't um, inhibit her a lot. I mean, of course, it was worrying, but in her case, she had a payout of 300K. So the child's payout was a $250,000. She had a payout of 300K. On top of that, she had a plan that was life, that had what we call a premium waiver in the event of a critical illness diagnosis, and it included early stage. She had a plan that was $6,000 a year, an investment plan, that till today, and I mean, this happened about 8 years ago, the insurer is paying for her because that plan is meant to be paying for life. The insurer is paying $6,000 a year for her retirement because she had this premium waiver rider that waives all future premium in the event of a critical illness diagnosis. So in total, they had a payout of 550,000. I mean, this was 8 years ago. By then, she had chopped up this 550, right? So what they did was, that was, of course, while the child was still in remission, and then the husband and wife thought, okay, now wife and child can no longer be insurable. There's no way they can buy more insurance. So what was the best way to plan for their future medical needs? Because they must create a medical pot, right? So what they did was they used the $250,000, bought an apartment, a one-bedder, in the child's name, in trust, held in trust. Okay, so it was fully paid for, held in trust, because this was 8 years ago, right? $500,000, I think they topped up a bit more, 600 plus. They were able to get a one bedder. Then when the child passed on, of course, everything was sold and liquidated. But my point is this: because one case was he was hardly insured, and the family is left stranded. And this other case, same couple, one child, one boy on each side, right? This other family, because they were, well, in that way, adequately insured, that payout became a means for them to create future medical fund. Okay, so that's the difference. When we are in the sandwich generation, what we cannot afford is that loss of income is a major thing. And then not only loss of income, when there is one person is impeded, in fact, mother stopped work for a while, right? In order to be able to get well. So they were on a single income for a bit. And in this case, husband and wife earn kind of quite equal monies, not like the husband was the main income breadwinner, unlike the other family. So, but because they had insurance planning, she had the option to stop working entirely. In fact, she did stop working entirely. Okay, and she started some small, home business from there on. Okay, so that's the difference when we do planning and we don't do planning to protect our loss of income. Okay, so that's the first thing we want to have in mind for sandwich class. You don't want a financial drain when something unexpected happens to our health, because to Indra's point, our greatest asset is a healthy body, mind, and soul. You are absolutely right, because without that we can't function, right? Okay, so now the second thing that we want to take note is this, that we want to protect the value of our money. I mean, I'm talking to an investment circle of people here, right? So you all know better than anyone else. But I want to highlight the fact that it's about using income that we have to generate income. An asset is something, a property, a house that you have can be an asset or liability. If it's fully paid for, it's an asset. But if you have a loan on it and you don't have enough cash flow to pay off that loan, when something happens, it can be a liability to the family members more than it is an asset. Of course, simplistically, we can say just sell the house and downgrade law. But it's not so easy. Can you imagine losing someone and all your memories is in this house, and the last thing you want to do is have them evacuate the house because they can no longer afford staying in that house? It is not nice, right? And I don't think most of us will want that for our family members. So that's the part where we want to use our income, the active income we earn, to generate income. So many of you here will understand that because you do active investing, whether it's reinvesting, it's options trading, it's property investing, second property to create rental income, that is using your income to generate income. And for some of us who do not have the risk appetite, and that's where I have a third family to share with you. They have been my clients since my early days. And they had 2 kids along the way. And I remember it was when they were about 35, crossing into 36. That was the year we sat down and husband and wife told me, all our friends are buying a second property, but we do not want to buy a second property. Why? Because they don't feel like they have the risk appetite. They want to live in that way, loan free as much as they can. So they didn't want to go down that route. But they know that by saving a loan, it cannot do them very much. Because the whole idea why we are buying a second property and all that is because we want to grow our money. But they don't have that, because they don't have that confidence to say that if any one point in time I want a single income, I cannot, it's hard to sustain a second property, so they decide not to, right? So that was when they came to me and say, we want annuities. So they did their homework and came to me asking, what kind of annuities can I buy? And you would think, right? Okay, honestly, they were one of the early ones that I met who actually planned for to that point in time. I never had anyone below age 40 asking for annuities. Usually I'll talk about annuities to people who are in their mid-40s and 50s, right? Because we are like 10 years, 15 years away from our retirement age. And so we want something more stable. But for someone in their mid-30s to come to me and already done their homework and say, I want annuities, right? It was honestly a surprise for me. But I learned why they wanted that, because they were very safe people and they wanted to have the liberty to one person stop work and not have the liability. Therefore, other than saving in the bank is liquid money, but they want to make their money work harder so that they will have a paycheck the moment they stop working. And that's why they wanted annuities and not endowment. But all the years that I've known them, right, they are the kind, from the day I took over their portfolio planning, they already had like 3 endowment or something. So those of us who know what endowment means, right, it basically means that you set aside money for 5, 10, 15, 20 years, whatever years you choose. And then at the end of 30 years or 25 years, in the past, it used to be all very long. At the end of 25, 30 years, then you get a whole lump sum. Okay, that's what endowment does. It's forced savings. You cannot touch it until it matures at the end of 20, 25, 30 years, then you get a whole lump sum out. Annuities, on the other hand, is you put in out money for the next 5, 10, 15 years, then come your chosen retirement age, you get monthly income. Okay? So this is a family till today. They never stop single income. They are both still dual income. But I see them very carefree. They are able to go holiday, big family holiday, their own small family holiday, and they are freely doing that so long as they can coordinate their leave. So the point is this: just because we are conservative and sometimes we don't want more liabilities doesn't mean that we have no choice. We can always use our income to earn more income, right? Whether it's current income, that's where your dividends come into play if you're investing, or your rental if you're having a second or third property, right? Your properties, extra property that earns an income, actually that is using your income to pay the loan, or that rental income to pay off the loan is generating income. But for those who are very conservative, the best thing you can do, rather than earning that 0.05% nominal interest rate in your bank, or even if you use your multiplier accounts, it's capped at a certain amount, right? 100,000, 200,000, that's probably max. Then beyond that, what do? Then that's where this couple is a clear example. They already see in mind when they stop work, and for them, right, because they started early, they wanted the money by the time they're 60. Because in their mind, they will retire between 55 to 60. So from 60 onwards, when they stop an income, they want to make sure that there is a regular paycheck to them for 20 years to age 80. So that's what we did. They got their first annuities when they were 35 going to 36. Okay, so but because they, and then the rest of it is really liquidity. When what they didn't, because they kind of plan their money such that all this is whatever extra income they earn because of increase, because of bonus, all that became extra money for the family to be free to spend as they want now. And to spend it with their family. They do bring their parents out on holidays. And so we say, you know, sandwich generation, we want to be able to treat our parents well and have them enjoy while they can. And so they were able to do that because they were of little liabilities compared to many of their friends. Okay. And then the third thing that we want to have is we're talking about protecting our future self. So in part, this is related. Like for them, they created the annuities is for their future self. They cannot touch the money, right? But the whole point is that when we are very clear, things get messy, right? When we cannot see where sources of fund come from. If you have multiple sources, okay, let me try the whiteboard again to draw it so that it's clearer. Just give me a moment. Okay. Oops. Okay, STMTLT. What does it mean? Short term, mid term, long term. If you short-term money basically is your liquid funds, your emergency funds, your day-to-day funds, keep it liquid, right? Today we are in a fortunate situation whereby T-bills, every 6 months, every 2 weeks, you have a new tranche of T-bills, and every 6 months you get your money back. If you are keeping emergency funds and you're really not using it, or you haven't been using it for the last 1 year, use T-bills to create more income. Because rather than putting in the bank and earning 0.05, your T-bills right now is still more than 3 point, the last one was 3.73 per annum, right? Of course, it's for 6 months, so it's half of it in actual dollar. But finally, for a long time, our cash was not earning money. In the last 1 over years, our cash can earn us money. Use it. But for the midterm, what do I mean by midterm? Midterm are usually things between 5 to 8 years or so, or even 5 to 10 years. Usually long term is 10 years or more. Okay, sorry. 10 years or more. Okay. Okay, 10 years or more. All right. That will be long term. Different instruments are available with different timelines because I use by the same word, endowment. Endowment is something that's for long term. If you want money in the short term, you cannot use an endowment to help you because that will be losing money when you terminate the plan halfway. But if it's for long term and then you put it in T-bills, which is short term, then you'll find that in 6 months, 9 months time, when T-bill rates go down, you have a reinvestment risk. You're now going to reinvest, but it's way lower than your 3.7 right now. In fact, if you were to Google, you know, there's all this public information. If you were to go and Google the T-bills rates before all the rate hikes last year, they were all well below 2%. In fact, at 1%, below 1% for a pretty long time too. So understand that we do not use short-term instruments for long-term savings needs. So protecting our future self will mean that there will come a day where we will entirely stop work, not by choice, but sometimes most of us will be by choice, but sometimes situations happen. You need to take care of a family member. We talk about sandwich generation, right? I know so many friends who have had to stop work and be caregivers to their parents. Okay. And those of you who have followed us in the earlier, you will know that like 2 years ago, exactly, we just crossed 2 years, my dad was very suddenly taken quite ill. And if not for the fact that I work a very flexible work arrangement, I think I will probably have to quit my job if I really wanted to spend my time with him. Because at that point, we weren't sure if he will make it, right? So if we want to create monies for our future self such that we are freed up then to be able to do something, again, your greatest asset is your ability to earn, is you. You're well today, you earn the income, compartmentalize it to short-term, mid-term, long-term, so that there's always something in the future that is waiting for you. And we're not talking about future, luxury items. We're talking about future basic needs. It's already there because you have, while you are earning, steadily saving that aside. And in the future, say when your parents have certain needs, we talk about medical funds for the parents because they are not so insured. That's where we have money stashed aside also to be able to give them the best treatment we want and know that we have done it right by them and not be guilt stricken after they're gone because we felt like we didn't do enough. So that's the part where we want to create, multiple pots of income, not using our primary income to create multiple streams of income, and then compartmentalizing the monies into different pots, different timelines, so that we leverage on different tools to maximize the planning that is ahead. All right, so the three things to sum up would be, first and foremost, for us to what do you call that? Protect our income. So protect from loss of income, professional income. Number two, to basically protect the value of your money. So make sure use your income to generate income. Then the last thing is to protect your future self. Create the money that your future self will need, whether to be a caregiver for someone to have the liberty to do that, or just to be able to retire worry-free. All right, so these are the three key things I want to share that I think many of us in the sandwich generation can give a little more thought to.